Listen up, the stock market is going absolutely mental right now. I am looking at my screen and seeing red everywhere. Oil, financial services, airlines, travel, a bunch of these massive companies are down 50% or more from their all-time highs. Everyone is panicking, but you should be salivating. Opportunities like this do not come around often. If you have been too scared or too cautious to invest until now, listen to me, starting to invest during a recession or a market crash is every single investor's dream. But it is not quite as easy as saying just buy all the stocks because everything is cheap. Investing is a lot like going to the gym. It is a lot easier said than done. There is still a massive amount of uncertainty in the coming months, and your emotions are going to try to ruin you. That is why in this video I wanted to go over the top 7 investing mistakes that beginners make. Because yes, a stock market crash is a golden opportunity. It is a once-in-a-lifetime chance to buy quality assets on sale. However, that does not mean you can throw all caution out the window. You cannot just forget about the tried and true principles of good investing. There is going to be a lot of volatility in the stock market in the coming days, weeks, and months. As you put together your investing game plan, you need to avoid these traps. Number 1, by far the most common mistake I see beginner investors make is not even investing at all. I get it. It feels a lot safer to keep your money in a boring bank account. Cash in the bank gives you this sense of financial and emotional security like nothing else can. In fact, you should always keep some cash in the bank for emergencies. You need that buffer so you do not have to sell your investments during a crash just to pay your electric bill. However, there are lots and lots of people who keep all of their life savings in cash. They do this for their whole life. This is a massive mistake. Quite frankly, it is a recipe for becoming a bag lady or a bag man in your old age. The reason why keeping all your money in a bank account is a terrible idea is inflation. Inflation is the silent killer. Cash steadily loses its purchasing power at a rate of roughly 2% per year. That means over the next 30 years, your uninvested cash will lose more than half of its value. According to the Federal Reserve charts, the dollar has already lost half of its purchasing power just in my lifetime. That means if I have the same amount of money. Now, as I did back then, everything is twice as expensive for me. Imagine everything being twice as expensive when you are older and retired. Cash in the bank provides the illusion of safety, but if your money is not growing at a rate faster than 2% to outpace inflation, you are falling behind. It is like trying to walk up a down escalator. You are moving, but you are actually going down. That is why just saving money is not going to cut it. You have to save your money and then you have to invest it. It is the only shot you have at beating the system. Yes, there are emotional hurdles. The volatility in the stock market is not a walk in the park. With the recent drop in the markets, my own investments are a total bloodbath. It is not fun to look at. But I am willing to put up with the ups and downs because the alternative is poverty. It is either let inflation destroy my savings or put up with the volatility to give my money a chance to grow. I choose growth every single time. If you have never invested before, it is going to feel scary to pull the trigger. It was scary when the market was at all-time highs, and it is scary now. The emotional experience of risking your hard-earned money never goes away, so stop making excuses. Stop procrastinating on your decisions. Stop putting off what you know you need to do. Make a plan, do your research, and get invested. Moving right along to beginner investing mistake. Number 2, which is not having an emergency fund. Before you start buying VO or VTI, it is vital to build a reserve of cash. You need money you can tap into when life hits you in the face. Your car breaks down, you need $2,000 for a new transmission. You get sick and need to take 2 months off work. You get laid off because of some corporate restructuring. This stuff happens, that is just life. The last thing you want to do is sell your investments early just to cover basic expenses. Even worse, you do not want to go into high-interest credit card debt. That is why the emergency fund is your shield. Back when I was in middle school, 9/11s happened. The economy took a massive hit after that attack. The company my dad worked for shut down completely. He did not have a job for a long time. Our family went months without any income. I remember it being a super stressful time. My parents did not have an emergency fund. They ended up having to tap into the college investment fund they set up for. Me and my sister, I am pretty sure those investments lost money because they sold at the bottom. The end result was we did not have a college fund anymore. This tip comes from real-life pain. Do not take it lightly. You need to have an emergency fund before you try to start investing. Do not try to run before you can walk. Otherwise, you risk selling at the lowest point in the market and destroying your progress. The stock market is extremely volatile in the short run. If you invest $1,000 today, there is a good chance it will be $800 next month. Then it might go back up to $1,200 the month. That is just how it behaves. It yo-yos in the short run, but it follows an upward trajectory in the long run. Look at the chart of the S&P 500 in late 2015. There was a lot of volatility. It was up 8% 1 month and down 5% 3 months later. But if you zoom out to 2020 or 2026, we are way up. That is why you should only invest money you do not need for at least 10 years. You cannot look at your brokerage account like an ATM machine. If you are wondering how big that emergency fund should be, start with $1,000. Once you have that, you can start small with investing over time. Build it up to cover 3 to 6 months of living expenses. The next mistake is waiting too long to start. Once you have that starter emergency fund and no high interest debt, you are ready. But I see so many people getting ready to get ready. They wait for the perfect time. Theoretically, the best time to buy is at the absolute bottom of a crash. But how will you know it is the bottom? Nobody knows until it has already passed. Hindsight is 2020. If a miracle cure for a pandemic or a massive economic stimulus happens tomorrow, the market will rip. If you were waiting for the bottom, you would miss the boat. On the other hand, the market could go down another 30% from here. Nobody knows. Stop wasting your energy trying to time the market. If you are a long-term investor, timing is a waste of time. It is tempting to try to pick the tops and bottoms so you never see red, but that approach will have you waiting on the sidelines for years. Even if you had a crystal ball and knew the bottom was today, would you be brave enough to buy? When the market is crashing, everyone is panicking, the news is screaming that the world is ending. Experienced investors are selling. Everything is 10 times scarier in the moment than it is on a chart. As a brand new investor, the chances you will have the discipline to buy at the bottom are slim. I am being honest with you, do not wait. If your situation is stable, you are ready. Now set a date, pick your fund, and stick to it. Now, I am not saying you should dump your entire life savings in on a Monday morning. That brings us to mistake. Number 4, investing too much money at once. If you are brand new, practice with smaller amounts. Watching a $100 investment go down 10% feels a lot different than watching $100,000 drop. Do not try to run before you can walk. Start with an amount that feels comfortable, maybe $100 or $500. See how that feels in your gut. If you can tolerate the swing and you are not lying awake at night, then add more if you invest too much too fast. It will be a shock to your system. You will end up doing something stupid like panic selling. Panic selling has permanent consequences. You lock in the loss and you miss the recovery. So the key is to start small to train your nerves and then ramp up. But eventually you do have to get aggressive, because mistake number 5 is not investing enough to actually matter. A study by the Schwartz Center for Economic Policy Analysis says 40% of Americans will fall into poverty in retirement. I do not want you to become a statistic. Let us do some real math. If you want to retire in 15 years and you want $50,000 a year to live on, when you factor in 2% inflation, that $50,000 lifestyle will actually cost $67,000. To get $67,000 a year in income, you need a nest egg of $1.7 million. That is based on the 4% rule. You take your desired annual income and divide it by 0.04, or just multiply your income goal by 1.7 million. Sounds like a lot of money, and maybe you will have Social Security or a part-time job. But even to hit a $1 million goal in 15 years, you need to invest $2,700 a month. If you have 30 years, you need about $500 a month. Investing a few bucks here and there using Roundup apps is not going to cut it. Acorns and Stash are great for proving you can save, but the Spare Change 1T build a $1.7 million empire. Aim for at least $500 a month as a baseline. Put it into a tax-free account like a Roth IRA. That leads us to mistake. Number 6. Not investing with taxes in mind. Taxes will be your single biggest expense in your entire life. It makes sense to minimize that bill. If you invest in a standard brokerage account, you pay income tax on dividends and capital gains tax on profits. Tax rates can range from 20 to 40%. That takes a massive bite out of your wealth. By using a Roth IRA, you are giving yourself a 20 to 40% head start. I see so many millennials using Robinhood. I get it. The app is sleek and the marketing is great, but for the longest time, they did not even offer IRAs. If you are starting with a taxable account before you max out your tax-advantaged accounts, you are selling yourself short. Start with a Roth IRA at a place like Fidelity or Vanguard. There are also 401ks and HSAs that offer massive tax benefits. Just ask any professional investor. Taxes are always a primary factor in their strategy. If it were not for taxes, we would all be way richer, since they are unavoidable. You have to be tax savvy. Finally, mistake number 7 is not being honest about how hands-on you want to be. There are different ways to play this game. The easiest way is to buy low-cost index funds and put them on autopilot. You can expect a 7 to 10% annual return over the long haul. You set it and you forget it. Another way is to buy individual stocks and companies you believe in. If you do the work, you could see 20 or 30% returns, but reading annual reports and crunching financial statements is hard work. 90% of people do not have the time or interest to do that properly. You have to find a style that works for your life. I used to spend all day researching individual companies, but lately I have been too busy with this channel and getting married. I had to be honest with myself. I have shifted mostly to index funds because I want to be invested without the stress of constant research. If you want to set it and forget it, go with index funds. If you want to be totally hands-off, hire a robo-advisor. If you want to do the work for higher returns, then learn how to analyze stocks regardless of the route. It is better to invest than to stay on the sidelines. It is not even an option to skip this. If you want a secure future and want to beat inflation, you have to get on board better to do it sooner, rather than later with an approach that fits your personality. I have made every single one of these mistakes. I am sharing this from personal experience so you do not have to feel the same pain. I hope this has inspired you to stop making excuses and start building your legacy. If you found value in this, give it a thumbs up and subscribe. I post new videos every Wednesday to help you get your money right. I will see you next week, same time, same place. Get out there and get invested. Stop checking your phone every 5 minutes for the market. Price Your Future Self is counting on you to be disciplined today. Do not let the fear of a red day ruin a green decade. The math does not lie, even if your brain does. You have the tools and you have the knowledge. Now, the only thing left is the execution. I know you can do this because I did it, and I am just a guy who got tired of being broke. Take the first step today. Check your bank account, set aside that emergency fund, and open that Roth IRA. The compound interest clock is ticking. Every day you wait is a day of freedom you are giving away. Let us get to work and build that 1.7 million. It is closer than you think if you just stay the course. Peace out. See you in the next one. Bye. I am serious about the $500 a month. Find a way to cut the expenses and make it happen. Your retirement depends on it. No more excuses. Just results. Keep your head up and your portfolio diversified. The market always recovers. It has a 100% success rate of recovering from every single crash in history. Bet on the world and bet on yourself. That is the best investment you will ever make. I am rooting for you. Now, go make it happen. Talk soon. Goodbye for now. Keep grinding. Stay focused. Wealth is a marathon, not a sprint. You have got this one step at a time, $1 at a time, one share at a time. The journey of a million miles begins with a single trade. Do not let the volatility shake you out of your position. Hold the line. Think long term. The noise is temporary, but the wealth is permanent if you stay disciplined. Okay, I am actually leaving now. Go trade, go invest, go grow. Catch you later.